Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, we are off to a good start this year. The equity markets are higher. We just saw an inflation report come out just recently that the market positively reacted to, where core inflation and CPI were just a tick lower, but it looks like we're heading in the right direction. So that is positive news. Certainly, we're likely not out of the woods yet, because the Fed is still committed to raising interest rates per their language and actions. But what I wanted to do today was give us a little perspective on where we were, just a brief update, and what history showed us when we're looking at the stock and bond markets. So let's dive into that data. When will stocks and bonds bounce back? Again, good year so far year to date, but 2022, as you know, was quite rough. The S&P was down around 20%, and really it was one of the worst years on record. And the prior worst year was 2008. You may recall the S&P was down around 38%, and of course 74 and 2002 were really bad as well. The Nasdaq fell more than 30%. The best performing indices on the equity side was the Dow. It was only down around 9%. Now, you may recall that when markets, and I've shared with this in other videos, when the markets, have a downturn, the Dow stocks tend to hold up best. Why? Because money managers need to be generally fully invested. So effectively, they need to be parked in equities. Well, the Dow tends to have some of the largest, strongest balance sheet companies and are on a relative basis safe. So this is why the Dow likely held up the best. But again, 2022 was a really rough year. You know that. Note, it is rare for stocks to fall 2 years in a row. And really, it only happened in the 73, 74 timeframe. And of course, in the early 2000s when we had the dot-com bubble. So history is on our side for a positive market year. Again, if history is any guide, well, since 1950, the S&P has been up 80% of the time following a down year. So that's good news, generating a 15% average rate of return. Now, of course, note that the past doesn't necessarily equal the future. And of course, there's no guarantees, but odds favor we're going to have a positive year if history is any guide. Again, doesn't mean it's guaranteed, doesn't mean it absolutely will happen. Now, of course, when the index is down more than 10%, which of course we saw in 2022, as noted, the following year has been up 63.6% of the time, with an average of 8.5%. And the S&P has been down 20% or more only 3 times. And then generally speaking, there's been positive years following. So that was the stock or equity market. Now, bonds, of course, bonds actually had a bad year too. As you know, we had a number of interest rate increases that negatively affects the bond market. Well, the bond market was rough in 2022, falling on average as measured by the aggregate bond fund. It's around 13%. In the previous worst year, really was in 1994. You may remember back then, if we were investing in the bond market, we were down a bit, which is really rare for bonds. Now, the bond market, most people have a traditional stock and bond portfolio. So the bond market, which again, theoretically is part of the portfolio to hedge or to protect against rough patches in the financial environment. It's there as an asset class to balance the traditional equity growth type of portfolio. So most people, especially if you're nearing retirement or in retirement, you likely have some level of bonds in your portfolio. But you could see here, the last couple of years, the aggregate bond returns were negative. So let's hope that does not continue. Let's hope the bond market stabilizes as well. Obviously, everyone would like to benefit from rising markets. So stocks and bonds together, only 3 times in the last 50 years, in 94, 2018, and 2022, did both stocks and bonds fall in the same year. So this is a really rare moment we saw last year, or time frame. That's more of an aberration, if you will, than the rule. Again, this data coming from New York University. And as noted earlier on the equity and the bond side, but combined together, during the following years, after both stocks and bonds were down, the stocks gained 34% and 29% respectively. So positive news there. Again, if history is any guide, which As we often talk about, the study of market history does not necessarily mean it will repeat, meaning what happened in the past may not necessarily happen in the future, but what it does do, it gives you an indication what may likely or probability states will happen. Because what you're looking for, in my opinion, when you're investing in markets is clues to give you an advantage, to have a higher probability of success. Obviously, if you study market history, at least in theory, you have some level of advantage. Now, again, I shared some positive news. Let's hope 23 is better than 2022 was on both the stock and bond side. But I want to share this with you. We're still in in my opinion, a big picture downtrend. Now, the good news is the equity markets held what's known as support in October. Notice since October, around mid-October, the stock market is actually, generally speaking, rebounded. I know there's probably some individual positions, of course, that have not, but by and large, the equity markets have rebounded. That's good news. And again, we're very early in 2023, but it's very positive. Now, will this trend continue? Only time will tell. We certainly need to have patience and no doubt continue to be aware of what's going on in the environment. And what I mean by that is rising interest rates. We're starting to see some companies starting to lay off folks. So we may see that unemployment rate creep up here. Again, the CPI number was positive, but as I've noted, sometimes or a few times in the past, the consumer seems to be slowing down a little bit in terms of purchases. But that's probably because, a large amount that are on individual credit cards. So we're not out of the woods just yet, but at least short term, very positive. So hopefully that continues. All that to say is, if you would like a second opinion on your portfolio or financial situation, you can go on our website. This is what our website looks like. Click on the Request an Appointment tab, fill out the information, and one of our advisors will get to you and answer your questions and hopefully give you some confidence in today's challenging financial environment. Thanks again for watching. Bye-bye.